All right. Good morning, everyone. We are live, kicking off your week. Today we got Monday morning. I got W2 to Freedom. We got Justin Cambra on. So morning, man.
Good morning, sir.
Yeah,
Happy
it's
Monday. Let's get
yes, great way
rolling.
to kick off the week. Hopefully your fantasy team did okay. Hopefully you don't have Joe Burrow on your team.
No, I'm actually in the lead, but depends on Nico Collins tonight.
Oh,
So
that's right.
as long as he's below 17 points, I'm in. I have
See,
my first win of the year.
see, that's how bad it. That's how far behind it. I forgot there's even games tonight. So a game tonight.
Yeah.
All right, well, let's kick it off. So this is I think a lot of people know your story,
Mhm.
fairly know my story, but they kind of, I mean, I know you want to kind of discuss maybe the beginning of our journey, where we're at now, and how maybe our situations relate, don't relate, and whatnot. So I know you sent me a few questions or ways to start it, so I'll let you go first. So how did you start then?
I started back in 2016, and I think there's a lot of people who are on this live chat, or what Dion likes to say, Futureland, that have some sort of epiphany that, hey, I don't want to do this anymore. So when I say this anymore, it's meaning the hustle and grind for the W-2, and you don't have any. Feels like you can't get out, and it's almost sad in a way. So that for me, that was when I was starting to work at Amazon between 2013 through call it 2016. Most money of my life, but definitely the most stressful and the highest grind of my life. And that's when I said, hey, I've got to find a way out of this. What am I going to do to get out of it? And for me, the real estate was the simplest solution. And I started in 2016 with a house hack, a duplex, South Seattle, one bedroom up top, three bedroom on bottom, large lot. I used to live in the top unit, the one bedroom, and rented the three bedroom out below. So that was my first investment.
Nice. So yeah, mine is a little bit. I mean, I got on the path to homeownership in 2008, no, 2009. But like I said, I tell everyone I never considered myself an investor. That was more just I was totally in that path of, you buy a place to live or home or whatnot, and you kind of just sit on it for 30 years, like especially in Hawaii with appreciation, and you're set, right? And especially me being in the fire service, with a great retirement benefit package, pension, whatnot. I was just pretty much just coasting along. That was kind of my plan: get the home, pay it off in 30 years, and now I'd be set free. Um, did transition to a single family home in 2015. Still was able to keep the condo, but even that, even though I was renting that out, I believe because of the HOA, the maintenance, I probably was had an alligator slightly,
Hmm.
but even at that point, I still didn't consider myself an investor. It was more just kind of, fortunately, I'm able to hold on to it and not pay that much out of pocket. So I was just going to keep it. I really probably didn't start becoming considering myself an investor until 2021. So that's kind of my journey. I've 1031 out of that condo to this point, and that home that I bought in 2015 just recently. Um, we can dig into it later, but I guess it's kind of maybe me and Frank, and we're trying to come up with a name for it, but I guess it's somewhat of a maybe a reverse house hack style or boomer hacking, where basically now that home is it's become a rental for me as I kind of move back home with my parents to kind of help them in the older periods of their life. So that's kind of where I'm at right now. So
When did
let's
you you said 2021 is like your official investor start. What and you had that other property prior to that. What age was that? Just for context here, because I know a lot of people are like,
Whoa, you're gonna throw me under the bus now. Let's see, what am I now? So I
making
am
you do math in the morning here.
I am 49. So what would that be? 5 years?
So 45.
Yeah. So, but like I said, I totally just was never thought about investing in real estate. It was more just, like I said, pay off the home. I would try to pay it down as fast as possible. I was definitely doing that, velocity banking, that type of thing. And that's kind of why, though, I was able to have a good amount of equity in these properties, which helped me as we dig into the investing side of things. But yeah, that's how my journey started.
Nice.
And let's see. So, okay, so you started 20, so how did you well, actually, so let's kind of clear things up too. So I am technically still have my W-2 on paper. I'm out of work right now. I'm probably considering next year sometime is when I'm just gonna step away already for good. That's the plan. You are completely out of the W-2, right?
Yeah,
But
100%
but
on
you have the agent
W2.
side, right? You do the real
Yeah.
estate stuff. Okay. Okay, so and then let's see, maybe how did you start with your first investment property?
So for me, I knew I wanted something that would help me make money, right? So I was like, well, it has to be a large house. I rent by the room, which at the time I didn't know was called house hacking. I called it and one, kind of like basketball lingo, where you get fouled and then you have the and one free throw shot. And so I was just looking at large houses, duplexes, triplexes that were all in the Seattle area. And it took me a couple months to actually find something. It was really hot back then, and I kept getting bid out or wasn't in my price range or anything. But finally found after kind of the ups and downs of trying to find something, found like the perfect property and kind of pushed all my chips in on it, and did a FHA loan. So original list price was 450, and ultimately bought it I think 20% above. I was like 535. So and then I did the 3.5% down. So I think all in I was sub, even with prepaid insurance and taxes, sub 25,000 for my first investment property.
How did you decide on, I guess, maybe becoming an investor at that time, or what made you jump into real estate?
My main thing is like um, I knew I wasn't going to be super rich in the stock market, because I got my first job out of college was 2001, and so then I'm basically 15 years into my in retirement, and I'm gonna have to kind of estimate the numbers, and that at that point in time I might have had a couple 100,000. I'm just like, there's no way I'm going to get there at this pace. And I don't have any advantage. The stock market has, everyone has predominantly the same amount of information. So real estate was my only asset that I could figure I could get into that would make sense. And so I just jumped all in on real estate.
Yeah, so we have a lot of people tuning in. Before we move on, let me just say good
Yeah.
morning to everyone. We got Frank, old guy REI here. Flavio from Grandview, Washington. Yes, Joe V talking shit about my Bears as usual. They look horrible. But John deconstructing dreams. Hopefully you're resting up. He's having an eye issue going on right now. So hopefully he had a detached retina. So hopefully he's recovering from that. Good morning, Jacek, Kenny. Let's see. I saw Jason here earlier. Flavio does say, good to hear how you guys started, and that's motivating to me as a newbie investor. And I kind of just want to also maybe touch on that as how, because I forget, sorry, you may have mentioned it, but how old are you again? Or how,
I'm 46,
so
so we're only a
okay,
couple of years
so,
apart.
but you started, you'd say when you were 30. Okay. So like for me, I think mine would be more to hopefully people can hear my story and realize that it's not too late to start in a sense, even though you're maybe headed down this path of one direction of thinking of maybe focusing on paying off your home, and maybe you do have a great retirement set up from a pension and then great benefits. So it's not too late to transition and change that mindset, and I think that's what we're going to dig into shortly. For me though, like I said, I think 2009 is when I got my condo, and that's right when the housing crash kind of started. It didn't impact Hawaii that much. We're kind of isolated slightly, but we did have where we got the tax credits and whatnot for purchasing a home at that time. So there was benefits for getting into the housing market at that time, when housing was crashing probably across the country in a sense. But for you, you said 20. So how did was your market in that 2015, 2016 time frame? Was it still kind of a down market in a sense? from that housing crash?
No, man, it was when it was really starting to come up. So Beth Traverso, who's another, she's a top agent up in this area. I think she was saying on her between 2018 to around 2012, 2013 is kind of the peak to the trough, and then 13 is when it started rising up. But definitely 16 was hot because, like I said, I had to go 20% above list to get the property that I wanted. And it wasn't just that property. There was multiple properties that I went and bid on that I ended up not getting. So it definitely was hot at that time, and it feels like really since 2016, it's been just kind of up and to the right for everything.
And then I want to also say, so when I did go from the condo to the home in 2015 was when my son was going to be born in, so many numbers of months or whatnot. But same thing too. It also goes back to me always trying to, and I made this mistake. I tell people I always made this mistake where I was buying a home almost as if it was my dream home in a sense, where it probably handcuffed me for many years as far as investing in a sense. So I definitely always feel like I should be so much further ahead if my mindset was different. And that's why I always recommend to people, if you are going to buy a primary home, or if, whatever you may be qualified for, definitely probably buy, you know, below what you're qualified for so that you have room to invest and all these housing expenses that can come up. But for me, 2021 is when my mindset really shifted. The kind of the world shut down, things were, it really got me focusing on where me relying on my pension, me relying on one stream of income was not the way to go about it. So definitely 2021 is when I started looking at other um, ways to invest and make more income. So I used a lot of the equity that I had in the properties that I did previously buy, and that's how I got started. So for me, that was my first dive into out of state investing, and we can get into that and on why I picked that market and how I got started. But my first property was basically using lines of credit or the equity that I built up in the properties that I had in Hawaii.
So you had two properties in Hawaii at 2021, and you did it whether a line of credit or cash out refi to use that for your because you're in Pittsburgh, I think, right?
Yes. So no, what did I do, a cash out refi at that? No, no cash out refi at that. It was just so like I said, I already had um HELOCs already in place because I was in that mindset of I was doing the velocity banking strategy of focusing on paying down the mortgage, or converting it to a first lien, first position HELOC. At that time, I believe Hawaii, they had such favor. We still do have very good HELOC products compared to everywhere else. So I believe, like, you have the intro rates at like 1.9 simple interest on the lines of credit. So you just focus on all your paychecks, all your income flowing through that, and then you pay your bills. So you try to keep that balance as low as possible, but that's how you're paying down that debt. It's not amortized. So that was kind of what I was doing, because I definitely was in that, no debt, pay off your home. 30 years from now I have no mortgage and I have my pension and I should be good, right? But 2021 is where, like I said, where my mindset shifted, and because I had these lines of credit already in place, that's kind of how I got into the investing side in Pittsburgh.
Hmm. I like that you weren't investing, but it's kind of the Dave Ramsey approach. You're accelerating debt pay down using the velocity banking, uh, which I love that. And when I'm working with other people, if you aren't buying a rental property, say you have a primary resident and you aren't currently looking at buying a rental property, or aren't ready, don't have the funds to buy it, at a minimum, you can still be progressing towards financial freedom by doing what you're talking about. That velocity banking of having a HELOC and paying down that basically use the simple interest to pay down amortized loan. So that's a huge you're making progress while you're waiting for your next move.
Yeah, and let's see. Let me see. There was a couple. Let's see. John does say, got my duplex in 2012. Had 5 properties fall through, and lending was really hard to get. Joel V giving me crap in 2021 is when I woke up from my nap. He said at the firehouse. John says 2012. There wasn't the lending options we enjoy today. I use FHA with the 203K option for the rehab. Hey, Hyder's here. Hyder hopefully has some cool information in the next few weeks about some seller finance deals he's probably working on, but that'll be good to hear. Um, yeah. So let's see what. So we said. Okay. So okay, we'll skip over the content. But so why did you? So you invested in your backyard first, right?
Yes, yeah. It started Seattle first, and then I went to Yakima for the second property, and that was, for people aren't from Washington, it's almost 3 hours east of me. So the first one was August of 2016. The second one was February 2017. And then October of 2017, that's when I started going out of state.
Okay. So as far as going out of state, then why did you pick the market that you did to start in?
And so I picked Milwaukee. I heard about it actually on Bigger Pockets. And it just so happened to coincide where I would do a golf trip to Madison with people I used to work with prior job to Amazon. And so I was like, okay, well, let me check it out. So I used to go into Chicago, and then I would rent a car and drive to Madison. We do the golf trip. So this time I flew into Milwaukee, got a rental car, hung out for the day in Milwaukee, met people through Bigger Pockets, set up some meetings there, went then went to the golf trip, and then when I came back, I met some other people, and then I flew out of town. And that was for people who are tax people. If your business trip, the majority of your time is related to business, you can write that off. So that's so it was a 2 for 1. I was learning about Milwaukee, and I was able to write that trip off. And that was back in that would have been 2017 August when I took that first trip.
All right. Flavio says Yakima is my backyard. Hey, I see Andy here. Yeah, that so for me, Pittsburgh, like I said, if I knew the things that I at that time today, that I knew those things at that time when I started investing, I mean, I probably wouldn't have started with Pittsburgh. Um, it was more that I knew someone that was already investing there,
Mhm.
and that's why I kind of piggybacked off of that individual's systems since he was already in that market. But if I was starting today, I mean, there's probably other areas that I could jump in now just based on, contacts and relationships that I have now. But for me, that's how I got into Pittsburgh. It was more that I knew someone that's in Hawaii also that was investing in that market. And so I kind of piggybacked off of their systems and whatnot. So that's how I found Pittsburgh. And I mean, I like it. I'm glad I've uh, am investing there. I think there's a lot of pros to it, but just like any market, any market does have its own challenges. And definitely, if I was starting over, I think I could probably find something a little bit closer. I mean, it would still be out of state, but I think it would be probably a little bit closer. But that's also based on who I know in that market. So it still come back to what individuals I know, and that would be the next question as far as like the contacts or relationships that you've built now. Like, how do you go about building these relationships or contacts that you know in your market that you're investing in?
Yeah, for me, it was like very strategic. So I'll start with local people first, and then I can talk about the Milwaukee people. So for um, buying local, I had before investing, I had bought some properties before, just primary residence. So I had an agent already that could help me with the Seattle area stuff. But when it came to investing in not in my backyard, 3 hours away, I did hear about a guy. YouTube. I was listening to YouTube. He has a ton of Bigger Pockets podcasts, and I heard about this guy in Yakima. He was like the king of Yakima. Enrique Jevons is his name. So I knew that he would go to these local meetups on the west side of the mountains. And so I went to a meetup, I saw him there, met him, and just became friends with him, talked to him about how he started investing. And, he ends up having a property management company, which is awesome. So I can use his company to help manage my properties. So that was how I started in terms of making contacts, is finding out what I needed. For me, not being local, I needed a property manager. And he was an agent as well. So I get an agent and the property manager at the same time by working with him. And he was, I mean, I don't even know how many. He had over 100 units when I first met him. I don't know how much he has today, but it's good to learn from somebody who's definitely farther ahead than you. And so he's really instrumental in kind of get me rolling on that. And then I just kind of took that knowledge and rolled it into Milwaukee. Did the same thing. I reached out. Now I couldn't physically go meet these people, so I would reach out to people on Bigger Pockets. Anytime it said Milwaukee for my keyword search, it would go into my email inbox, and so I'd look at these, go on the Bigger Pockets platform, and I'd reach out to them. So there's a couple different lenders, insurance provider, and agents, and so I would just reach out to them, talk to them. When I would go into town, I'd meet them, and that was how I got started. And then every time I was in town, I'd try to meet somebody in person, ideally that I was already connected with virtually.
I like that. I think that's one of the most underrated things in this whole investing journey is making contacts and building relationships, and especially if you are investing out of state. I think that's super important. I know Jovi, you asked Jovi is he investing? He is in the Milwaukee area, so he also has been in contact with Brett. I know you've helped Brett in his journey also. So do you still have a lot of good connections in the Milwaukee area, Justin?
Yes, I would say not as strong as they were, just from my shift of focus has been more local. Now that I have a real estate license and a brokerage team here, it used to be 80-20, 80% looking at Milwaukee, 20% here. That's like inverted. So 80% of my time I'm focused on Seattle. So not as much communication as there was in the past. But when I would just constantly keep in touch with other investors, like what are they buying? What are they selling? Who are they using for contractors? What are the on rehabs? What were the different costs they were paying? And then I would always throw it out because, like, some of these other guys I would be chatting with are not in Milwaukee either. Like, there's one guy in LA that I would connect with. And so if he was in Milwaukee, he'd be like, hey, you want me to swing by any of your properties, check on anything, and vice versa. So we kind of help each other out as we're going.
Yeah, and I think that's what Zuber always talks about too is meeting two new individuals a week. And he doesn't mean just meeting in person, but whether it's over Zoom, whether it's, a phone call, but it could be a lender, it could be an agent, it could be a property manager, another investor. But I think that is super critical. But especially if you are going to invest out of state, having those relationships is super important. And I mean, I'll kind of dig into that a little bit later on how important I think it is. But they even also had so this past weekend, or was it this past week or 2 weeks, maybe 2 weekends ago, but they had the Gary, Indiana meetup where
Yeah.
Millennial Mike, Dion Lumberjack were there, and some of the other investors were there. And then Jack put together a in-person Pittsburgh meetup. So Jack is boots on the ground there. He invests there, and then other people that are looking at that market went out to check it out. And like Mikey, who's also in Hawaii, also went out there to check out his properties for the first time. And the funny thing is Mikey loved it so much he's actually thinking about moving there. So he loved it. He loved the people, and he thinks he'll probably be able to, cut that timeline if he was to move there, right? He'd be able to house hack and do those things. So he's definitely considering relocating there.
Hmm.
Let's see. So let's talk about now that first deal and then scaling up from there.
Yeah. So my first deal in Milwaukee was a duplex, and it was I think it was listed for like 65,000, and I ended up negotiating it after inspection and everything. The ultimate end price I want to say was either 61.5 or 62.5, and so and the reason for that, ironically, I didn't know this until then. I ended up working with U.S. Bank to get some commercial loans, and based on how the loans are set up, they don't like small loans because there's a lot of paperwork and not as much money in these smaller loans. And so I basically couldn't go below, I think it was maybe it was 61. I couldn't go below 61.5 because it was just too low for them. And then there's also like these lending laws based on the rates and stuff that they were charging me. It was considered predatory lending, but it was more so that it was like a flat rate thing on a very small loan amount. And so that's how we ended up actually negotiating the 61.5. I was trying to go for a, a lower price, but the lender was like, we can't even do the loan if you go lower. So we ended up landing on that 61.5. It was a duplex, but it's getting fuzzy. It's been a while. So I want to say it was like 550 or 600 per unit rent. And then it was, the mortgage at the time, because it was around, this was 2017. Gosh, I want to say rates were around 4-ish%. So like my total debt on that thing was like under $300. So like the mathematics make total sense. The one thing you know that you don't know until you actually get into it, the reason why these are cheaper is that there's so much inventory out there. It's actually, um, you know, uh, it's easier to buy them existing than to build them. And the reason for that is you buy them and then you can fix them up. So all these buildings, yes, they were super inexpensive, but yes, they had a ton of deferred maintenance. And that's where my 10% for repairs, maintenance, and 5% for capex were way grossly underestimated on some of these properties. And so what ended up happening, like some of these properties would have like 20, 30% repairs and maintenance on them when you look at it at a high level. So, as I started scaling up, I bought more, in, you know, further down the line, I ended up trying to get in a little bit better area, a little bit nicer condition, such that I wouldn't have as many of these large repairs, and quite frankly, better tenant base. Because like the lower the rents are, typically the lower the quality of the tenant. And so, but that I scaled up from, let's see, 20, I'd say 2017 to 2021 was really my massive ramp, because I was at, 2017 property number one, 2021, I probably had 20-ish properties at least in Milwaukee by that time. So it was just kind of rapid expansion at that time.
So Lynn has a question for you, and I'll add this to what my question. So Lynn's asking, if you were starting investing today, would you still start out of state? Would you invest locally? And then my question added on to you scaling up would be, I believe you started doing a lot of partnerships, right? And did you start adding like hard money lending as part of how you started investing? And when did you maybe start deciding to bring in partners and stuff?
Okay. I'll answer the first question first. One from Lynn. I always recommend, and I would still do this today. Step one is do a house hack. You get your highest leverage, 3.5%. So, especially those living in expensive areas, the house hack is the easiest way to get in. So I would still do that. And if I started over again, I would do more house hacks. All else being equal, knowing what I know today, like who would have thought it was gonna, geez, more than double in Seattle, and some areas have like tripled in that time. So I could have had a bunch more equity if I had bought more locally. But in terms of out of state, let's just say hypothetically, if I didn't have as much money to start with, I probably would have started out of state again as well, because it's a way for you to get in with lower lower dollar amount. So instead of 100,000, maybe it's 20,000 to get your first property. And, for people starting out, that's the hardest part, is getting the knowledge and then getting that initial kind of bankroll to get that first property. And then once you get that first one, now you have proof of concept and you can kind of build towards getting that second one. Second question was,
Yeah, about like when did you decide to bring on partners and maybe start using hard money lending and whatnot?
so for me, what ended up, it was out of necessity. So if you're a real estate investor and you're expanding, you're going to run out of money. It's guaranteed. So at some point in time, you're going to need that money. So for me in 2016, I used my own money. And then, I was fortunate. I had all these what are called restricted stock units at Amazon. So let's see, every 6 months, I was getting uh, a tranche of money. Depending on the year, gosh, I don't even know how much it was back then, but it was probably 40 to 80,000 at a time, depending on how much the stock went up, right? So then I was taking that, selling it, buy, taking the money, sell it, buy. And then so I was using my own money. Then I learned about solo 401ks. So I was buying properties in I converted my old retirement into a solo 401k. I bought a couple of properties out of there. Then the market had gone up. So then I did a cash out refi. So I bought more properties then. And then at which point in time, okay, I think it was around 19 properties. I used all my money and I was like, well, I want to continue to grow. And at which point then I started to, I'd been talking to people over those years about investing. And then other people were like, well, yeah, I'd love to invest with you. Okay. So I was like, sweet. I was pumped. I was like, I can't believe people would want to invest with me. Right. And so I ended up doing the first one. And then I ended up doing kind of a series over maybe 2019 to around 2021. I did four, of which I've sold those properties. We made the money, gave the money back, and everyone's happy. I still have one partnership left. They want to continue to expand, and we have some larger properties. So I'll probably keep that one going. But yeah, it was more out of necessity to continue to scale up because I didn't have the money. And then your last question was, well, when did I get into hard money / private money? So hard money, I used, I would say, really only in the last 2 or 3 years, and that was usually to flip a property or do a burr. But in terms of private money lending, I've been doing that probably 3 4 years. Or I'll do like a burr project where I borrow, and one of them I borrowed the money to buy the property, the money to fix it up. Once it's all fixed up, then I did a cash out refi, paid off the private money lender. Um, I don't know if I've had ever a full burr, but instead of putting 20% down, I might have had 5% down or 10% down. And if you think about that, like if it's 5% down versus 20, I can go 4 times as many properties with the same amount of money. If it's 10 versus 20, that's 2 times as amount of buying without with the same money that I had.
Yeah, I like that. I think you were on with we were on all together with Cody Davis a couple weeks ago also, right? And he's kind of going through that phase of maybe getting himself out of partnerships and kind of everything's his portfolio himself. So for you, after going through this, and like you said, I think you said you have one partnership still remaining. Would you Do you like going the partnership route? Is that, or do you think it's not for everyone?
There's definitely pros and cons. All of the partnerships I had, they all went well. It's just that over time, people have different philosophies, strategies, time investment, expertise, and so some of the properties that are in, basically what happened is we would buy like 1 2 3 properties, and the ones that I was doing is I was still doing the bookkeeping and the property management follow up, the working with the lenders, and buying strategy. But it was a 50-50 partnership, and I'm like, you know, if we're not gonna scale up and I'm doing all the work, this doesn't really make as much sense in today's world than it did when I first was wanting to get in. And luckily at that time, basically everything had doubled, and so we were able to sell the properties, pay off the loans, and then take our money and reinvest it into whatever we personally wanted. But as I started exiting out of the W2 world, I wanted to focus more on my creating another revenue stream, which is my real estate brokerage company, and doing fix and flips and daddy projects in Seattle. And so I had to like free up mind share and time. And so that's what I was getting out of the partnerships.
I do see a few people tuning in from Instagram. I see Alex Dinsmore and Howie Noel. So if you guys are still there, come check us out on YouTube. But thanks for tuning in. So for me, but I think I want to go back to also like, building contacts, relationships, and just getting started. Because I think that's where those opportunities of hard money lending or even private money opportunities or even partnerships come into play, right? So I think a lot of it is just you have to get started first. And, like you said, I think you said proof of concept. So, if you're showing people what you're doing, and I think that's where this whole even like social media comes into play, right? It's just you don't have to be great at social media, but I think you
Right.
just putting out there what you're doing so that people can see it, sharing your wins and sharing your losses. I think sharing your losses is very important too, because I think people put more trust or faith into that. Because when you don't show losses, they're kind of skeptic, like, this person is only showing me the good times, right? So
Yeah.
I think it's super important to talk about wins, losses, but just show people what you're doing. And even like for me, I've had opportunities to like partner with people, and even people lend me money, and it's just never, I don't know. I just never felt comfortable doing it. That's just not um, maybe the strategy, or just I didn't want to deal with the headaches. And I think that's more, like I said, Dion has kind of his mindset, and how like he always talks about how have you seen people, right? Like it's just hard having someone else, a partner in a deal, right? But like you said, different goals, different strategies along the journey. So for me, that was always why I didn't want to do it. I am taking on my first private money lending in some of the new purchases that I have made recently. So we'll see how that goes. But same thing there. I'm not expecting to get um, like a complete burr, like you're saying, right? My hope is that it's definitely going to be less than putting down a 20 to 25% down, right? So if it is, leaving some money in the deal, it's still a win. I mean, that's the way I'm looking at it, but it's also more for, like you're saying, proof of concept. Now, is it something that I want to continue doing? How's the relationship with the lender? And so that's kind of why I'm doing it, also for my channel too, so I can talk about it as far as my experience with it. But for me, my scaling, I guess, was more, and I think some people know my story already, is I went more just all in from a scaling standpoint, because instead of you where you were borrowing from your retirement accounts and leveraging that, I kind of went all in and said, heck with it. I'm not going to deal with all the loopholes I have to jump through to borrow off of it, or borrow at this time when I retire and pay. So I just said, you know what, I'm going to take the hit now, pay the penalties, pay the taxes now. And now it's my money to invest. And I always talk about how I'm glad I did it. Uh, I definitely could have been more strategic about it. And I think that goes back to what you were saying, like proof of concepts. Even if someone's going to lend you money or want to partner with you, they want to see a proof of concept. And for me, I think, and I go back to me being, like I said, more strategic. If I should have had a better proof of concept of what I was doing, instead of just, if I did buy like 4 properties first, and I thought it was just easy. I thought it was like, oh, this is easy. Like there's no, just find a property, buy it, get property management, and I'm good, right? And as most of us know, these first 5 years kind of do suck, and there is these things that pop up, maintenance that you don't expect, or tenant issues. And so that's kind of why I feel like if I went through some lumps earlier, or waited, I'd definitely be a lot further with those funds. But like I said, I'm glad I did it. So I do have more leverage now. And like I said, Mikey, I was talking with Mikey yesterday, and fortunate for me, it's just when I did get in, rates were lower, right? So a lot of my properties that I did buy or acquired at the time, they're all in the fours, right? So even though I feel like I made a lot of mistakes, fortunately the rates were a lot lower than they are now. So now with the market that it is now, I'm probably going to have opportunities to have these properties that have equity, good amount of cash flow. Now, how do I want to leverage them right now? And now we're in a buyer's market, right? So I have different opportunities now, compared to when the rates were lower back in 2021, right? So it's just different opportunities, but I think you have to get started, right? So you have to get started to have these levers to pull. Um,
On that, just a follow up on that. So you cashed in your, so you have a pension, but then you cashed in whatever retirement account you had. That was the seed.
from previous employments
Yeah.
and whatnot. So that I just liquidated and said like that. I don't want to deal with. I mean, maybe you can touch on that too, like because you said you borrowed off them and whatnot, and so it's kind of like you have all these hoops you have to jump through, right? Like, and even like if you're investing through the retirement account, right, you can't take the cash flow, right? It's like it has to be put back into the account. I don't think you get the tax benefits, right? You don't get the depreciation on your taxes, right? So there is all these loopholes you have to do. So I was like, you know what? I don't want to deal with that. Like you said, I'm not gonna get into stocks. That's not something I'm interested in. I don't want to really learn how to invest in stocks. Real estate is the way I'm gonna go, and that's why I just kind of said, I'm gonna liquidate everything and jump all in.
And so then you paid the 10% penalty plus the whatever your active
Yeah,
income.
yeah,
Okay. So probably a good 35,
yeah.
40%.
So, like I said, I definitely could have been more strategic about it, um, but I think just getting started to me was the biggest benefit for me.
Hmm. Yeah, I mean, everyone has a different strategy and philosophy, but I think the common theme, and this was kind of the point of the live stream, is we have different strategies, locations we invest, but we both took massive action, right? Like for somebody to cash in their retirement, I mean, that is like, literally putting all your chips in, betting on yourself and trying to control your future. And that was similar. I didn't cash mine in, but in terms of I would use all the cash I had, and I basically rewound instead of increasing my cost of living, I was decreasing my cost of living. So went from, nice house to an apartment to a smaller apartment to then a house hack where I lived in a, call it 750 square foot single bedroom for like 8 years. Because I was like, every dollar I save, I can put into an investment. So I think that's the common thread here is make we made this is like Tony Robbins. He was like, you make up your mind and go. And so we didn't think about it. Once we made 2021 to today, like how many properties you at today?
I have 17. No,
Exactly.
yeah, 17.
Yeah. So basically in four-ish a year. So when you made up your mind and then you've been buying basically one a quarter. And so, and for me, I was at 45. Now I'm at 33. But yeah, it was very similar where we made up our mind, massive action consistently over time to get where we're at.
And I think for me, and I always talk about it, is that for me, my pension is like that fallback option. So it's such a secure job, working for the firehouse and having that pension in my back pocket, that that's also why I think I'm a little bit riskier than maybe other people who, yeah, you have a W-2, but you don't have that pension in place, and pensions are very rare now. So I think that's also why for me liquidating the retirement account was more I was fine with it. I was fine taking that risk.
Mm.
But definitely you do have to weigh, like you're saying, you have to weigh your options. And but Lynn does have a good question, since you actually have completely stepped away from your W-2. She said, how long was it into investing that you decided to quit your W-2? And maybe for me to add on to that, did you kind of test it out, like Dion kind of tested out his amount of cash flow coming in before he actually stepped away?
No, for me, it was so I started in August 2016. September of 2022 was my that's when I left the W2 world, which is actually next week will be my 3-year anniversary of leaving the W2 world. And for me, really, the decision maker wasn't even actually the cash flow. Were they cash flowing? Yes. Was I living off the money? No. Some of the money, like I said, we were talking about, is in retirement. So there was, I think I had 4 properties at the time in my retirement. So obviously that money can't get until I'm what 59 and a half or whatever it is. So what for me, what did it was I did a flip and a wholesale deal first 6 months of 2022, which made 100,000 at Amazon. In 6 months, I made 100,000. But I was like 80% of my time was at Amazon, 20% was investing. So I was like, well, what if I did 100%? And so for me, my natural transition, like my goal was to generate active income outside of the W2 world, have the cash flow as the fallback. And so I still focused on wholesaling, fix and flip. And at the same time, I got my real estate license. And that was like my natural buoyancy, if you will, for the cash flow. And so, actually now, I'm very fortunate through the relationships that I've built in the past. You know, I actually make more with a real estate agent business than I'd ever did at Amazon, but nowhere near the time commitment. And so now I use that active income towards doing more fix and flip projects, more long term buy and holds. And, now what I'm trying to focus on is um, paying off a chunk of them to where I have kind of in your what you're talking about. If I pay off a chunk of them, that would be conceptually a pension for me, right? So I'd love to get a chunk of them that would be enough for me and my fiance to live off of that, and then everything else we can keep the active income, be in, strategically invest in other stuff, but then have this core uh, pension that we can live off of. We're fortunate she actually has a pension at her job, so that kind of counteracts everything I do. She has a 401k and a pension, so like I'm full risk. She's very steady Eddie, no risk.
See, that's it. It works out though, right? And that's how you're kind of looking at the overall portfolio and assets that you folks have. And I think that's also like the real estate, your agent or brokerage side. That's kind of also how you've built it too, right? So you've worked hard, you put in the time, you've built up your name, your brand, and your team, and now you're kind of able to step away slightly and be less hands-on, and your team is the one that is maybe doing a lot of the day-to-day things, right?
100%. Yeah, the goal here is like, you know, like the W2 to freedom, right? So for this year, I'm going to be just over 130 days of travel. Now, I count any day that I'm not living at home as travel. So, like this last weekend, I was in Spokane for a couple days, and I've got basically something almost every week, all the way through November, first week in November. So almost every week I'm doing something, and some of these are like a couple days. Some of them like we got a 21-day trip in October coming up, but like it sounds, W2 to freedom. The goal is that you live a life by design. So I can still do all the stuff that I'm doing anywhere in the world. It's even like the real estate agent. Now, this is because I have good people in the team that can work with the clients. I can still interact and respond to the clients and the team anywhere I'm in the world. We use WhatsApp, Google Sheets, text messaging. So I can help analyze deals, find deals, follow up on inspections, all that kind of stuff, whether it's on a cruise ship or Even in, sometimes I'll be on a plane logging in and helping out that way. But, for me, like that to me is freedom, where I can still do whatever I want, but I'm still able to build my portfolio and build a business, because like I always want to continue to keep stacking and growing. For me, it's fun. I think I'd be bored out of my mind if I actually did nothing. Like, for some people, they were like, "Oh, I just want to sit on the beach." I can only do like one day on the beach, and I'm just like, now what?
Yep. So there is Justin's Instagram page to go check him out there if you want to connect with him. Like I think Jovi says he's going to reach out to you. He may be using private money. He's going to reach out to you. But yes, go check out Justin on Instagram. And like he said, you will see that he is traveling quite a bit. There's a lot of videos and stuff of his travels. And I believe you're going to the Bigger Pockets event, right? Next month? Is it next month?
Yes, glad you brought that up. I'm looking actually for a roommate. I haven't even booked the hotel yet. So if anybody has a hotel room that wants to share it, or vice versa, I can buy it and then you can share it with me. I'm looking for somebody to room up with. So and I think it was around October 5, 6, 7, somewhere in there. So hit me up on Instagram, W2 to Freedom, or my other channels at 4JC Cambra.
Um, Jovi said, "Oh, Jovi has uh, he doesn't have Instagram." He said, "Well, I'll get you Justin's number, Joe, and you can reach out to him. Or like Brett has it too, so
Mhm.
you can connect with him that way." Let's see what else. Well, we can kind of wrap things up with a total of, let's see, current market and I guess what your strategy is today, because I think you are kind of focusing on a new strategy right now, right? So,
Exactly. So what we talked about the agent income, but for me right now is how can I make the goal is, can I do some investment projects in this area that can either burr or generate income. So in this area, doing single families, then adding detached accessory dwelling units. Excuse me, that's the way to go. So I have two different projects going on right now, which is, come to find out, way harder than I thought. A lot of not L's per se, I'll call them learnings, which, once they're done, I'll be able to share more of them. The learnings keep on coming on those. So that's been my focus right now. The beauty of it is that I'm learning it and I'm going to apply it to future deals myself. But I'm able to take this real world knowledge and help my clients and my team help their clients on investing in these types of projects as well. So more of a coaching and helping people from real world experience has been what I've been doing. And I've been selling off in the Midwest. So like I have one that's going to close by the end of the month, one that's going on market this month. So hopefully sell those two. There's and the reason for that, I've talked on previous one, is I had a ton of 5-year commercial debt in 2021, of which all of them but one will be is left, and I need to refinance or sell that one. I think it's February of next year. So, um, yeah, so that's why I've been selling a lot of them. It's like, well, let me repurpose. They're coming due, and the interest rates will double. Let me repurpose that money into an investment, take it from the Midwest and then pull it back into Seattle area. So that's what I've been doing.
yeah, I love that. Lynn saying, "Oh, Flavio has a person to room with if he's going to Bigger Pockets," because Flavio is always looking to bum a room off of someone. But I'm not sure if he's going to the Bigger Pockets event, but he will be in Vegas for the one rental at a time event. And I saw you bought your tickets for that also. So
Yes.
we'll see you in February. Yeah, so John, deconstructing dreams, like I said, he's going through an eye issue right now, but he says, yeah, he's sitting at home recovering from his eye surgeries and he's bored out of his mind, right? So, just like you were saying, right? You could be retired, you can travel, but you can only sit on the beach so much, right? And there's a lot of opportunities, and just from your phone, right? You can do a lot of work from your phone, deal with your
Right.
teams, transactions, Hey, CJ Underwood. What's up, man? Great conversation. Great dude. Yeah, see you in Vegas, I hope, CJ. I'm not sure. I haven't heard from you in a while. You're gonna plan to be in Vegas, CJ? Let us know. Yeah, but I love that. Like you said, so I think we go back, it goes back to the beginning, right? It's just you have to get started, right? You have to get started. And then now you have all these levers to pull. Like you're saying, you're moving properties from the Midwest back to your area because you see
Mhm.
this great opportunity, right? Like these dados, and how you guys are going to use that. And I think that's the number one thing people don't realize is you have to get started, and that's the I know it's the hardest part, but I think that's what's great about this community is that everyone is kind of doing something, and at different levels, right? Everyone is maybe, we're what, maybe 6 7 years in the journey or whatnot. You're a little bit further. There's other people tuning in that are just getting started, but that's the biggest thing is just getting over that hurdle. And I think for me, Dion, folks always talk about the 5 years of suck, and they're talking about the 10 years of the journey's 10 years. And I think for me, mine is probably quicker than 10 years in a sense, just because from where my starting point was, where I already had a decent amount of assets and retirement accounts built up. So that's kind of why my trajectory is maybe a little bit further ahead than that 10-year plan in a sense. But that 5 years hasn't gone away. That 5 years of suck is still there. I mean, there's no way to really get over that phase of it. So I've gone through my lumps, and only now I'm really starting to really see like the benefits. And now I have these different levers to pull. And going back to even like the relationships I've built in Pittsburgh, that's where like these off market deals are coming my way, or even like these private money lending opportunities. So that's kind of where why my I'll probably finish up the year with, getting like 7 units, right, in this ending portion of the year after kind of sitting idle for, 3 to 4 years, basically kind of just letting things stabilize. But that's just the daily relationships that I've built there.
Mhm.
Like, so for me, like it's in current market, I think after these last few units I get in Pittsburgh, I really might kind of almost only do one a year in Pittsburgh, maybe like it would have to be like a home run type of deal. Other than that, I'd probably look to maybe consolidating things as far as maybe getting out of some of these, like you're saying, these older properties that I got in the beginning
Mhm.
that they're fine, they're good they're solid, but at the same time you got to start looking ahead for these deferred maintenance and things. So that's where I might start getting out of the older ones, maybe start getting into some newer ones. And then even I might start really digging into or building a buy box in like North Carolina or South Carolina, because that's kind of where I see myself spending a lot of my time once I'm maybe retired to some extent. So I'll probably start maybe looking at some sort of buy box there, and if that's something I want to dig into. But yeah, I mean that's kind of where I'm at right now.
That's awesome. I think your levers and assets, I talk about this amongst my friends, is like, you know, because we, did the 5 years of suck, for me longer, it's still not easy, So but now I have assets, and I think about it as like chessboard and like pawns and, rooks and bishops and kings and queens, whatever you want to call them, right? Because like, you know, hopefully on Thursday, we do get the reduction in the Fed funds rate, and we see that continue to trend down. Now, Mark and I have all these assets. For me, it's 33. You have 17. These are assets, right? So, like, I could then go. Let's just say you know, we got. Let's say it went back to 4%, right? Now we just cash out refi. Now we're sitting on probably a couple hundred thousands of dollars to redeploy and go buy more assets. So because we have these, it gives us optionality, and that's where the freedom starts coming from.
Yes, and shoots. Actually, I think it was Cody. I'm not sure about you, but I know Cody's starting to dig into like precious metals and things like that.
Hmm.
I am kind of going down the Bitcoin space. I'm definitely not a Bitcoin maxi,
Hmm.
but I do like having Nick on here. Coach Massey, he's in California. He's went all in on Bitcoin. He's a regular on Zuber's channel now, but he's on my channel also. But I like his IBIT approach. It's more like an ETF, and you don't need the wallet and whatnot.
Mhm.
But it's definitely, if you're a Bitcoin maxi, you wouldn't be doing IBIT, right? Because,
Right.
but I like that easy approach that Nick is doing. So that's something that I'm definitely going to start digging into. And even like fractional real estate. I'm not sure if you've heard about that, but I have Joseph Kachapalia who's on my
Mhm.
channel. We go every couple of weeks, Fractional Friday. But
Yeah.
that's an interesting approach to real estate. Also, is buying it on the blockchain. I
Mhm.
do like that. But what about you? Are you looking to, do you dabble in Bitcoin and precious metals or anything? No? Okay.
No, I have, like, ironically, I just got a letter about it the other day because I set up an account, like, for what, 3 years ago, 4 years ago? I just put $100 in there just so I would actually pay attention to it, but my account closed down or something because they're like, "Hey, you need to, um, recertify," or something like that on Coinbase, so I have to go back into my account. I don't even know how much is in there now, but it's a couple hundred. But I'm like the opposite. I'm like, it doesn't make sense to me. I think it'll be the biggest the next big financial crisis. But I do have gold and silver. I just checked it while we're here. I'm like, most of my gold and silver was bought in the mid 20s, and it's at almost $43 an ounce right now. It's kind of, I mean, my silver. But yeah, it's crazy how much the gold and silver has gone up. But I guess we'll have to wait and see who comes out the winner in terms of gold and silver or Bitcoin or both of them. Who knows?
But yeah, I have to agree though. Real estate just makes a lot more sense, and it's a lot kind of easier to understand. Hyder, if you are still here though, I forgot to ask you this morning. But have you ever heard of the book Bitcoin Super Cycle by Michael Terrapin? Okay. All right, man. Thanks for doing this. Justin has another call. I know he had about an hour. But we'll get you back on again. And this was a good one, man. Everyone, thanks for tuning in. Have a great start to your week. Thanks, Justin.
See you guys.
All right, man.